There are moments in financial history when numbers stop acting as expected. Prices shift rapidly, markets decline, investors panic. But even during crashes, the system usually holds together. Orders flow, prices adjust, buyers and sellers eventually meet in the middle. On May 6, 2010, that expectation quietly changed. For 36 minutes, the U.S. stock market behaved in a way that few had ever seen. Nearly $1 trillion in market value vanished. Major companies lost value in seconds. Some well-known stocks briefly traded for just 1 cent. Others soared to prices that made little sense. Then, just as suddenly as it began, the market recovered. Prices rose again, trading returned to normal, and soon the system appeared almost perfectly healthy. However, what happened during those 36 minutes prompted regulators, economists, and traders to confront a troubling possibility. The modern stock market might not be as stable as it seems. To understand why, it's essential to examine how trading structures had quietly changed in the decade before that day. For most of the 20th century, markets relied heavily on people. Traders stood on exchange floors, shouting orders across crowded rooms. Decisions were made in seconds, sometimes minutes. Even when computers assisted the process, human judgment remained vital in determining prices and providing liquidity. But by the late 2000s, that world had mostly vanished. Most trading activity was now run by automated algorithms. High-frequency trading firms had created systems capable of analyzing market data and executing orders in microseconds. These programs continuously entered thousands of buy and sell orders across multiple exchanges, making money from tiny price differences repeated many times. To many observers, these firms seemed to improve the market. Their algorithms added significant amounts of liquidity. Liquidity is the unseen force that allows markets to work smoothly. It means that when someone wants to sell, there is usually someone ready to buy. Prices move, but they do so gradually. High-frequency traders helped achieve that smoothness by constantly posting orders on both sides of the market. However, this new structure also introduced a risk that few fully understood back then. Most algorithmic traders were not committed investors. They were not trying to hold stocks for years or even days. Their involvement depended entirely on market conditions. If volatility increased too much, many of these algorithms were set to withdraw instantly. And on May 6th, the market was already showing signs of stress. Earlier that day, global investors grew increasingly worried about a looming debt crisis in Europe, particularly regarding the financial stability of Greece. Stock markets worldwide had started to decline. By early afternoon, U.S. markets were already trending downwards. Then, shortly after 2:30 p.m., a significant trade entered the system. A major investment firm decided to hedge its portfolio by selling a large number of E-mini S&P 500 futures contracts. These contracts are financial instruments that track the broader stock market and are widely used by institutional investors to manage risk. The order involved about 75,000 futures contracts, valued at around $4.1 billion. Large orders like this are not uncommon, but this trade was different due to how it was executed. Instead of gradually selling the contracts while watching market conditions, the firm used an automated program designed to sell based on trading volume, not price. As long as market activity stayed high, the algorithm would keep selling contracts into the market. At first, everything seemed normal. Other traders and algorithms absorbed the incoming orders, but the selling pressure continued. High-frequency trading firms noticed the unusual activity. Their algorithms reacted by buying contracts, then quickly selling them again just milliseconds later. This created a quick cycle of buying and selling between machines. Contracts were passed quickly back and forth between algorithms. Trading volumes surged, and because the selling algorithm saw rising volume as a signal to keep going, it pushed even more contracts into the market. A dangerous feedback loop formed. Machines stopped responding to the broader market. They were reacting mainly to each other. Prices began to drop faster, volatility spiked, then the system reached a critical point. The algorithms that usually provided liquidity began vanishing. Many high-frequency trading firms have built-in safeguards designed to protect them during unstable times. If price movements become too erratic, their systems automatically reduce activity or shut down completely. From each firm's perspective, this behavior is reasonable, but when many participants withdraw at the same time, the overall market suddenly loses the liquidity that keeps prices stable. That's exactly what occurred. Buy orders began to disappear, sellers were left competing for fewer and fewer buyers, and the market started to collapse. Between 2:42 p.m. and 2:47 p.m., the situation spiraled into chaos. The Dow Jones Industrial Average dropped nearly 1,000 points, one of the fastest declines recorded at the time. Individual stocks acted in ways that seemed almost surreal. Shares of Accenture, a global consulting company, briefly traded for just 1 penny. Other companies saw wild spikes, with some trades executed at prices thousands times higher than their actual value. For a few minutes, the systems that typically maintain orderly pricing across the market appeared to break down entirely. Across the financial system, nearly $1 trillion in market value vanished. Then, gradually, the crash began to reverse. Market safeguards triggered trading pauses for certain securities. Liquidity returned slowly as algorithms resumed their activities. Prices began to rise back toward previous levels. Within minutes, much of the lost value reappeared. However, the event had already shaken confidence in the structure of modern markets. Regulators launched a joint investigation led by the U.S. Securities and Exchange Commission and Commodity Trading Commission. After months of analysis, their report found that the crash was not caused by one malicious actor or technical failure. Instead, it stemmed from a complex interaction between several parts of the modern trading system: a massive automated sell order, high-frequency trading algorithms amplifying market activity, and the sudden withdrawal of liquidity providers during extreme volatility. Researchers later described the event as an example of how automated systems can create strong feedback loops. When algorithms react mainly to the behavior of other algorithms, small disturbances can quickly escalate into large market movements. Most of the time, the system functions remarkably well. Prices adjust efficiently, liquidity seems abundant, and markets appear stable. But the flash crash revealed something crucial. That stability relies on conditions staying relatively normal. If those conditions change suddenly, the technology that usually stabilizes markets can instead amplify instability. For 36 minutes that afternoon in 2010, the world saw what happens when liquidity disappears faster than anyone expects. The market didn't collapse because companies suddenly lost their value. It didn't happen because investors collectively decided to panic. It happened because the machines that dominate modern trading briefly stopped trusting the market itself. And when that trust vanished, even for a moment, the world's largest financial system showed just how fragile it could be. And what if it happens now with AI?